What's the most important thing for any business? Well, no prizes for guessing because you've seen the title of this video, so you know what I'm going to say, and that is cash. If your business runs out of cash, it will die. That may not seem intuitive because most people would probably think being profitable is the most important thing. While profit is important and eventually you will go out of business if you're not profitable, if you run out of cash, you're going to go out of business a lot faster. Hi, my name is Rudolph Stewart. I'm an accountant and the founder of Outside Accounting, a virtual accounting firm serving the needs of small and medium-sized businesses. Today, I wanted to talk to you about something that I think is really critical for businesses, and that's managing your cash. A lot of times people focus on, making sales, getting costs down, just running the business in general. But really, one of the key things you need to be thinking about and watching very closely is your cash position. In this video, I want to walk through how to prepare a cash flow forecast because I think it is so critical for the success of your business. Now, in terms of a cash flow forecast, the first question is probably, okay, well, how often should I do this? Well, you could do it daily, weekly, monthly. Now, I just said monthly, but to be honest, I think that is far too infrequent. I actually probably wouldn't do it any less frequently than once a week. And I personally like to have them done on a daily basis. And the reason for that is that, you need to know how much cash is in your bank account every day, because if you have bills going out, if you have payroll that you need to meet, you don't want to bounce any checks. And so when you're doing a forecast, you're sort of like estimating what you think is going to be in the account. But until you actually check what's in the account, you don't really know. And I think doing that on a daily basis is really critical. So that's my recommendation. When you're creating a forecast, you can make it very detailed where you try to anticipate every single cost going out and every stream of income coming in. So I would say you probably should start off by making it a bit more general, a bit more high level, and then depending on your needs, you can make it a little bit more granular. For this series on cash flow, I'm going to do a few different videos. And so for this one being the first video, I'm going to make it very high level and do a very simple example just to give you the idea of how a cash flow forecast should be set up and the sort of things you need to think about. For this example that I'm going to use today, I'm going to open a lemonade stand. To open my lemonade stand, I plan to sell lemonade for $3 per cup. And I'm planning to sell 25 cups a day. To start the business, I need to buy a table, a chair, cooler, jugs, cups, napkins, mixing spoon, and signage. To make lemonade, I need to buy lemons, ice, water, and sugar. The cost of my startup materials is $350. I don't have $350, so I borrow it and I agree to pay it back at $25 per week. The cost to make 25 cups of lemonade is $1 per cup or $25. However, to make sure I don't run out of lemonade, I'm going to make 30 cups per day and spend $30 on lemonade. I spend $20 per day on transportation to get to and from the location where I set up my lemonade stand. So here's how my cash forecast would look. This is my sample cash forecast. You'll see it has the days that I am looking at. So in this case, it's a week, Monday to Sunday. And then it has a beginning balance, money coming into my account, money going out, and my ending balance. And this here is a forecast or a budget that I'm doing for the period. So it starts with 0. And as we discussed in the example, I need a loan of $350. And I actually didn't discuss, but I also need another $100 loan because I need to buy my supplies. Then my forecast says I'm going to have startup costs of $350, lemonade cost of $30, and then an ending balance from the first day of 70. So the way I've done this is I assume that I'm going to buy my supplies the day before. So I don't have any sales on this Monday. This is my first day. I'm going to buy all my supplies, including my lemonade supplies. And then on the next day, I'm going to start selling my lemonade. So my ending balance from the first day is 70 here. And then you'll see on Tuesday, I have an opening balance of 70. I'm going to add sales of 75 for the day. That is made up of $3 per cup of lemonade, and I'm planning to sell 25 cups. And then I have lemonade costs of 30 and my transportation costs of 20. So that leaves me with 95 at the end of the day. And then on Wednesday, I should start the day with 95. So that's how my budget is built. And at the end of the week, I should have $145 in my kitty. So then we go to Monday and we see what happens. So this is now looking at actual performance here. So at the end of the day on Monday, I actually have $20 in my balance. And so with the forecast, what I'd want to do is I want to look and understand what's happened. Well, when I look at my budget, I had budgeted $350 in startup costs, but something happened and I ended up spending $400 in startup cost. So what happened is I ended up spending an extra $50 in startup costs. So there's a difference here that shows that, my ending balance is 20. It should have been 70. So I spent 50, or I took in 50 less than I had planned, and I'm $50 over, and that's why I am off on my Monday forecast. I go to Tuesday, and as you move forward, historical data becomes kind of set as fact, so you kind of ignore the historical. So the Monday data is now here, and that's kind of become the actual. And on this day, I see when I look at the very bottom, I am $15 short. As of yesterday, I thought I was going to have 45 in my ending balance, but I actually only have 30. So I need to go and figure out what's going on here. And this day, I can see that I actually only sold 20 lemonades. So it's 3 times 20. I budgeted to sell 25. And so lemonade sales are $15 under budget. And that explains why I'm off there. I now go to Wednesday. And obviously, as you're doing your forecast, as you're preparing this, you obviously have to punch these numbers in, calculate what they are. In this case, I look and I see that I'm actually $10 over in my ending balance. I planned that I was going to have 55 is my forecasted ending balance, but I actually had 65. And when I do my checks, I see actually I only spent 10 on transportation. And I've got a little note here that says, oh, I got a ride to work, so I saved $10 in transportation costs. That's why I am over by $10 in what I had planned based on my last forecast. On Thursday, I look and I see that I'm up $20 based on my last forecast. And so after I review it, I can see that I sold 30 cups of lemonade instead of my forecasted 25. So I had $90 in sales that day. And then I see that I had lemonade ingredients on sale and I saved $5 on that. So instead of spending 30, which is what I planned to spend, I only spent 25. So with the additional 15 in sales plus an additional 5 savings in cost, I am now $20 ahead of where I had planned from my forecast the day before. Then here on Friday, I see that I am $60 below. And when I look, I see, oh, I didn't have a very good day for sales. In fact, I only sold 5 cups of lemonade. And so that's left me $60 below. If I look at my ending forecast balance for the week, it is 50. And that is, in this case, it's $60 lower than my my last forecast, which would have been yesterday's forecast. And when I checked to see what's happened, I sold 5 instead of 25. So I sold 20 cups of lemonade fewer than expected, and at $3 per cup, that's $60 in lower sales. So hopefully that was pretty simple to follow. Basically, you have a beginning balance from whenever you start, you have your money in, your money out, you come up with an ending balance. That ending balance becomes a new beginning balance, and then same thing all the way through. A couple things I want to point out. So here you have this calculation of ending balances, but then also you want to have also show what your forecasted balances are. And for your forecasted balance, that's your most recent forecast. Don't go back to, sometimes you can do a comparison between your ending balance and your budgeted balance, but oftentimes it's not worth it, because really what you're interested here is you're just trying to figure out how much cash you're going to have to meet expenses as they come up. And so really it's kind of like your most recent forecast that's the most important thing. The other thing to note is it's really useful to keep historical data. So for example, as each day went by, I would update it with the actual numbers, not the forecast. And that's going to be helpful because next week, for example, when you're doing your forecast, you might say, oh, on this Friday, I only sold 5 cups of lemonade. So maybe there's an issue with Fridays. Maybe people don't buy lemonade for a certain reason on a Friday. So having this information kind of helps you ask questions and think about what you do. Maybe you might not even want to open for business on a Friday because actually it's a money loser. If you're only going to make 15 and you're going to have 30 in lemonade costs and 20 in transportation costs, that's 50 right there. So in that case, it probably wouldn't make sense to do it. So again, looking at the numbers helps you kind of ask the right questions and think about how you want to manage your business. Hopefully this was enough to get you started on your cash forecast journey. I'm going to be making more videos on this topic, going a little bit more in depth and talking about different issues that could trip you up and things to consider. But I think that's it for today. I just wanted to keep it simple to just introduce the topic. If you want a copy of this sample file that I use, it's quite basic, it's quite simple, but I'm happy to share it. You can just go to my website, www.outsideaccounting.com, and just shoot me a note on via the contact form. If you have any more questions that you want answered before my next video, feel free to leave a comment on this video, and I'll do my best to answer it. That's it for today. I'm Rudolph Stewart, the founder of Outside Accounting, a virtual accounting firm serving the needs of small businesses. If you have any questions about how to set up and organize your finance and accounting function, feel free to get in touch with me at my website, or you can drop me a note down below in this video. Thank you. I'll see you next time. Bye-bye.